Social and political tensions combined with a global pandemic have resulted in volatility reminiscent of the Great Financial Crisis or maybe even the Great Depression. In early February this year, the S&P 500 reached an all-time record high. When that pandemic hit and we shut the economy down, it dropped an astonishingly quick 35%. Equally quick were the fiscal and monetary responses. It's been estimated that the combined effect was equivalent to 44% of GDP. The result? A 64% recovery in just 5 months, but led by a surprisingly narrow group of large tech behemoths. Now, Tracy is going to dive into the details of where we are today. Then she'll guide us through what to look for in the next 50 days and into 2021. Tracy?
Thanks, Jerry. Yeah, as Jerry mentioned, it's been an incredibly volatile year here in 2020. I think volatility has been maybe an understatement for all of 2020. Interesting year. So what we've had going on here is a rebound in the equity markets from our last highs back in February. So February, roughly 18th, 19th, we had a high level that you can see there in the top part of this chart. The blue line that says index level. We sold off quite scarily for everybody down here to the bottom in the March timeframe, and then we turned around and we bounced back. Now earnings are beginning to rebound. That's what you see down in the bottom part of this chart. Earnings reached a low of expectations of $140 per share for the S&P 500, and now they're starting back up to $154. And we're expecting those earnings to continue, those estimates to continue to move higher. So here we are, back up, regaining our past highs. It was about the middle of the middle of August when we regained those past highs. And we're up near a 21-22 PE ratio. So what does this mean? If you lift the hood on this, we've regained the highs, but what does this mean underneath? So looking at the details, I know if you've been listening to financial markets, you have heard the term FANG used. FANG stands for Facebook, Apple, Amazon, Netflix, and Google. And you can put another one on the end of that with an M for Microsoft so far this year. So the chart here on the left shows the performance of these 5 top holdings in the S&P 500 and then the performance of the index itself. The leading performer is Amazon up there in that gray bar, followed by Apple in the purple, Alphabet or Google and Facebook behind that, and then Google down at the end. I should say Microsoft and Facebook neck and neck, and then Google down at the end. And if you look over to the right, these stocks have done so well, and they're so large a percent of the index now that Apple alone makes up over 7%, Microsoft almost 6%, Amazon 5%, Google about 3%, and Facebook 2.4%. Everything else, 495 other companies in the index, only make up 76%. So if you add up those top 5, they're now almost 24% of the index. So you can see this another way if you look at the cap-weighted S&P 500 index against the equal-weighted S&P 500 index. Yeah, the S&P 500 weights companies differently based upon their size. So these large companies are really carrying more than their fair share of performance of this market. So if you take this index and you equally weight it instead of cap weighting it, you see a big difference in performance year to date, a 9.32% difference. That's pretty large. Before the sell-off and that little peak you see there in the middle of August, that difference was over 12%. So it's easy to see if you're an investor why you might be doing this. As we're coming through our COVID sudden stop that we had back in the beginning of this year, it's easy to see from the changes in earnings estimate expectations. So the first column here gives you the change in the second quarter earnings per share from a year ago. There's some pretty ugly numbers here, especially for the energy sector, one of the hardest hit ones. But notice which ones are hanging in there. Healthcare, which is normal for it to be a defensive area and not sell off as much. Infotech, which is where most of these companies that have performed well are located, it's still growing its earnings. And then utilities. Everybody needs to turn on the power regardless of what's going on. And then you move out to 2020 for the entire calendar year. Earnings for each sector generally get better. They're less negative. But tech, again, is holding in there. It's not moving that much. So even though you've got a lot of volatility and uncertainty out there, these companies in the big tech areas, investors are saying, this is where I want to hang out. And that's why they've done so well year to date. So there's an interesting little wrinkle in here. The red line here is the S&P 500 price index. Now, this is the cap-weighted index, so it is including the heavier weights to those 5 names that we talked about before. But this blue line, this is the American Association of Individual Investor Bullish Sentiment Indicator. So this is asking individual investors, how do you feel about the market? So even though the market is much higher versus its low in March and retained it or regained its old highs from February, investor sentiment hasn't gone back to where it was. Investors in general are still not that confident, which is why they have piled into those 5 big names and not spread their money out more broadly across the index. So Jerry,
thanks for that, Tracy. Well, I appreciate all that information. That kind of gives us an idea how we got to where we are today. But my question is, based on what you've just shown us on the consumer confidence side, what's it going to take to improve investor confidence? How are you thinking about the markets here in the near term, and what, pray tell, about the elections?
Well, we've got some interesting things going on here for the rest of the year. I've got a slide here that's got some GDP growth numbers on it. Let me back up a second and explain these GDP growth numbers. When you hear the headline GDP growth number in the news, you will normally hear what is an annualized quarterly number. So using this chart as an example, GDP for the second quarter didn't actually fall 31%. It fell at a quarterly number that if you annualized it would have been 31%. But to stay consistent with what most people hear in financial media and read, we're using those types of numbers. So these are annualized quarterly numbers. So that was quite a fall in the second quarter. GDP fell at a 31% annualized rate, almost 32. The expectations here are on these dotted lines. So consensus expectations among economists at the end of August suggest that the economy, as measured by real GDP, will increase by 20% at an annualized rate in the third quarter. Then we have another good quarter, 6% in the fourth, and then going into the first quarter of 2021, economists' consensus expectations expect the economy to be growing about 5%. So that V rebound that everybody talked about in the economy, not the markets, but the economy, that's the shape that is taking place here when you're looking at annualized rates of return. So when you think about this, if you're going down quickly, like this has been happening, and you think about that earnings expectation chart, what are you going to do? You're going to hide out in companies that are expected to weather this quite well. Then you're going to look out there and see, am I confident enough to begin broadening out my exposure beyond the companies that are going to get through this no problem? So what we start to look at is, how is the data unfolding in a way that will give investors more confidence about that GDP number rebounding in the second half of this year and into next year. So a couple of things here to look at. First of all, on the left, non-farm payrolls. This is the number of people employed. We had a call earlier today internally, and our director of fixed income came up with a great term. He was describing the economy as halfway back. And he showed a lot of charts that showed things were halfway back. And this was one of them. So non-farm payrolls, we are not where we were. February would have been the peak before we had the COVID shutdown, but we are roughly halfway back. Looking at job openings and layoffs on the right, this is good news. Layoffs and discharges, which is that red line, that's back down to the number it was before COVID hit. That's good news. And then the job openings are beginning to trend a little bit higher, and they're actually getting back to where we were before COVID hit. So good news on both of those. And this is a chart that we created to give us a little more insight into exactly where we're getting a rebound in the economy, and then maybe where we might lag. So it's an interesting thing here with the labor market. The labor market is actually a lagging indicator, not a leading indicator. But this happened so fast in March and April that people, I think, have forgotten about that a little bit. So you don't look at the labor market to tell you what's going to happen. You look at the labor market to tell you what has already happened. So take up here at the top, leisure and hospitality. The way you read this chart, we are taking the month of March as the baseline. That was the month before all this started. And then we're plotting April's decline in payrolls in that particular industry in the blue line. May's decline versus March is the red. June is yellow, July is green, and August is gray. So what you're seeing here is that versus March, leisure and hospitality jobs were down 47 almost percent to begin with. They're now down 21% from their peak. So all of these read the same way. Not surprisingly, leisure and hospitality was the hardest hit. Education and health was pretty hard hit as schools and hospitals and doctors and dentists' offices closed down. Construction was actually reasonably hard hit, but that didn't last long. That's come back. So one of the things we notice is that you've had that big bounce back since April, but that's beginning to slow. So the difference from July to August is not as great as that rebound difference from April to May. And this is normal. You would expect things to slow down, and that's consistent with that GDP chart as well. You get the big bounce back, and then you're back to a more normal rate of growth. So looking at small businesses and consumers, small businesses make up roughly 50% of all private employment in the US, and this was one area that we were most worried about going into and coming out of COVID. Small businesses don't have the same access to capital as large businesses, and that's important. Small businesses are the lifeblood of our economy, so we're really worried about those guys. It's looking better. So NFIB is National Federation of Independent Businesses, another word for small business. We look at these trends on their optimism and their hiring indexes. The blue here, that is optimism plans to increase employment. So small businesses in this survey are saying that their employment increase plans are back to where they were before COVID. So notice the level is consistent with February. And then on the red line, that is a general business outlook for 6 months forward. Now, while that has come down the past couple of months, compare it to February. It's still higher than where it was in February. So generally, these things are going in the right direction for small business surveys. Now, a little piece of not so good news. We want to be fair here. The Conference Board of Consumer Confidence, that has tailed off. We had a big drop here in March to April, a little bit of a bounce, but the consumer is not feeling quite as confident as small business owners. If you look at CEO surveys of larger businesses, those look better too. So the consumer is not quite on board yet. That probably has a lot to do with the labor market. That might have something to do with unemployment benefits. There are a lot of reasons why, but it's something worth watching because the consumer is 70% of our economy. Housing and goods movement. Housing has done fabulous through all of this. There was a short blip. Now the weekly mortgage applications and the NAHB housing index are at new highs. Interest rates came down and folks began to refinance and buy homes. Housing is a big multiplier throughout the economy, so this is an area that's a real positive for us, that housing has bounced and held up this well. Over on the right, railroad activity. So, think about when businesses shut down, inventories don't move. So that's what happened here. Rail activity really came off. Now rail activity is moving higher, and this is movement of heavy goods throughout our economy, coming in from our ports, moving into the interior of the country. So a nice rebound here, and this is another one of those measures that's now higher than where it was before COVID even began. So a little bit on looking at the market going forward. I'm sorry, there was no warning that there would be math. There's a little bit of math, not a lot. So PE ratios is a broadly measured index valuation methodology. There's different ways of doing this, but PE is what you hear most often. And people forget sometimes exactly how this is measured, even though it's quite simple. So you just take the price of the stock and you divide it by the earnings per share. and you get the valuation, whether it's a stock or an index. So if you're a PE ratio of 18, 19, 20, that's where this is coming from, just price divided by earnings. And we can apply that to market indexes or single stocks to get an idea of a range into the future. So what we've done here, we've taken the current S&P 500 index level as of a few days ago. So 3340 is about where we are. I think I took this on Friday. And if you take the current earnings per share estimate, think back to that one of those first slides we showed. So the current earnings per share estimate for the next 12 months is $154 per share. That's over here on the right, on the top part of the chart. That equates to a 21, almost 22 times PE ratio at this 3341 level. If you will remember that chart, prior to the sell-off in March, earnings expectations, I should say, were running about $180 for the next 12 months. So look all the way out here to the right, and you see the $180. And the PE on the market at that point in time was around 18. So the reason I show you this relationship is because we could return, remember earnings are now increasing, so we could return to the earnings level prior to COVID at 180 and the PE ratio prior to COVID at about 18 times, and the S&P 500 stock level on the index could not move at all. So that's your relationship. As earnings rise, PE ratios can fall, and you don't get hurt. If earnings fall and PE ratios rise, you also don't get hurt. Now, over time, you always expect earnings on the S&P to rise as long as our economy continues to grow, and that's the power of earnings compounding for stock market investors. PE ratios change a good bit. Long term, it all works out, but this is an interesting dynamic here. It's comparable in my mind to what happened in 2018. So as we came into 2018, we were looking for a nice rebound in corporate earnings per share because of the tax cut that took place. We were trading at roughly an 18 PE about that time, and we had a big move in earnings growth, but we actually had a contraction in PE ratios. And for 2018, the market was about flat. So we're in a situation today where we're looking for a nice rise in earnings again, but we're already at a 21 PE ratio. So even though we expect PE ratios to be supported because interest rates are low, it's of course possible that that PE ratio actually contracts a little bit. But as long as we have the increase in earnings that we're expecting, the overall market index level will hopefully be pretty steady. Now, as far as the election goes, one of the things that I tell clients about the election is remember that we do this every 4 years. This is not something that is brand new to the process. Now, granted, the political environment is a little different these days. So we have a research provider that we use by the name of Cornerstone Macro. They do some excellent work. And these are a couple of charts that they provided to us a few days ago. They have a political analyst, and he does a great job and it gives an opinion plus he quantifies. So we've got a couple of things going on here. Again, a little bit of math. I apologize. So on the left, what we're looking at here is the futures price of strike prices on the S&P 500 around the election. So this is looking at volatility in the month of November as it is being priced today. So this gets into some option pricing. The important thing to see here is that volatility expectations are heightened around the election. So these dates you see on the bottom are dates of the price of volatility projected into the future. I know, a little confusing. So just think about the market saying, how volatile will it be around November? The odds of that today are in this chart. So you saw a rise in volatility here above 35, say 36, 37. This was right around the conventions. So a lot of political headlines, 2 weeks worth of it, both sides giving it their all. So you saw a little increase in the volatility. Since then, it's coming down a little bit, but it's still projected to be a little higher than normal. But this is normal. Again, every 4 years we do this. So the next thing that they looked at, Cornerstone, was saying, okay, what happens if we have a repeat of something like 2000? If you remember in 2000, George Bush Jr., George Bush III, and Al Gore were locked in a race for Florida. You remember the hanging chads. It was a big mess, and it took a while to figure out who won that election. So here's the chart here on the right. It's plotted election day. This went to the Supreme Court. You've got the Supreme Court decision. And then people forget we were actually going into a recession at this point in time. So the recession started in the first or second quarter of 2001. So the point that's being made here is that the market, as measured by the S&P, this is the dark green line, was already kind of tailing off here going into the election. And the election didn't change that. The market was actually remarkably steady around that time, given what was going on. But the Fed started easing rates. So the 3-month Treasury yield is that light green line. So the Fed begins to cut rates, and we do end up going to a recession. So the point that was being made here is that even though there was a lot of uncertainty around this particular election, and it drug on for a little while, and it was quite ugly, the market really didn't change its trajectory because of that. So the chart on the left is telling you, yes, you could get some shorter term volatility around the election, but it's not really expected to change much in the longer term with the trajectory. So this is one of my favorite charts to show my clients and to talk to investors about. You know, we all say that investing is a long-term game, and it really is. This illustrates it for you. This is taking snippets of time of S&P 500 returns over different holding periods. So this first one here on the left is just 1 year snippets of time. Large variations in outcomes. So in any 1 year time period, it could be plus 50%, it could be negative 50%, but on average, it's somewhere around 11. Roll out to 3 years. Look at what happens to the dispersion here, maybe plus 30% to minus 30%, but the average is about the same. So you get the idea. The longer you go out, the less variable your outcomes have been in the past, and your average stays about the same. So if you're thinking about this in the terms of risk and return, you would want to think longer term with your equity investments. So our best guess here on the near-term equity markets, earnings should continue to improve as the economy recovers. We think that will broaden things out for the equity markets. You know, we've had these 5 stocks that have been driving most of it since March. We really should broaden out. The Federal Reserve keeps interest rates lower for longer. They have said this so many different ways. That should support valuations. That should support lending. There's a lot of things that the Fed is going to do, not only with interest rates, but with quantitative easing in their balance sheet. And then as the economic recovery broadens, that's where we would expect not to have all this performance concentrated in these growth defensive companies as it has been. And then some near-term volatility on the election, but please keep your perspective. We have had Republicans in the White House. We have had Democrats in the White House. We've had Republican controls of both houses of Congress. We've had split controls of both houses of Congress, and we've gotten through it. So keep your perspective on the election. Jerry?
And that is a lot to digest, Tracy. Thank you very much for that. Let me see if I can sum up a few of the key themes you've elaborated on. It sounded to me like you expect the Fed will keep rates at these extremely low levels for possibly a lot longer, and you think that's going to support equity valuations. And you see earnings likely improving as the economy recovers. You know, importantly, you see the concentration of capital that developed during this historic rally to disperse over time as that recovery broadens on out. Lastly, it won't be any surprise at all if the antics surrounding the election cause additional market volatility. But here's the thing we really want you investors to be mindful of. Even if we could forecast the election results with 100% certainty, what the market does in the short term is unknowable. We strongly recommend against changing your asset allocation strategy based on an unknowable political outcome. We strongly advocate staying focused on the long term and consulting regularly with your financial advisors. Now, with that, I'd like to thank you all again for your time and attention. A link to a recording of this event will be emailed to you in the next day or two. Have a great evening. Thanks again.